Welcome to This Explainer. Today, we're diving straight into the numbers behind Marsh & McLennan, ticker symbol MRSH, to solve what I think is a truly compelling financial mystery. We're throwing on our detective hat, so to speak, because this stock is sending us some incredibly mixed signals right now. Here's our roadmap for the breakdown. We'll look at the recent stock slump, unpack the fair value mystery, check out their profitability and growth engine, review the dividend track record, weigh some historical valuation comparisons, and finally, deliver our financial verdict. Let's get right into it. Section 1. The recent stock slump. Okay, so to put things into perspective, Marsh & McLennan is currently trading right around $161. That is a staggering drop of over 31% from its 52-week high of $235.78. And if we just look at this calendar year, it's down 12.3% year to date. Now, in the market, a drop of that magnitude for such an established company always begs the question, right? Is something fundamentally broken here? And what's really wild is the stark contrast between the short-term reality and the company's long-term history. On one hand, you have this brutal one-year trailing 12-month slump of negative 27.77%. Ouch. But then, on the flip side, you have an incredibly strong 10-year track record that delivered nearly a 200% return to patient shareholders. So it really makes you wonder, are we looking at a broken company, or is it just a broken stock price? Section 2. The fair value mystery. Well, let's look at what the math actually tells us. If we use a discounted cash flow model, specifically one based on free cash flow, which is great because it strips away all that accounting noise to just measure the actual spendable cash the business generates, the fair value price of MRSH sits way up at $212.29. Since the stock is currently trading near 161, these intrinsic value calculations are suggesting it has a massive amount of room to run just to get back to its true worth. So, the absolutely crucial point here is that this $212 target price gives us a 24.14% margin of safety. If you're the kind of investor who likes a buffer, a nearly quarter-off discount to intrinsic value is, frankly, incredibly appealing. It literally gives you room to be wrong. But as we all know, a model is just a model. We have to ask ourselves, does the underlying business actually justify all this optimism? That brings us to Section 3. Profitability and growth engine. Let's look under the hood. This brilliantly illustrates their pricing power. Marsh & McLennan maintains a literally flawless 100% gross profit margin. Now, because they're a service-oriented brokerage and advisory firm, their cost of goods sold is practically zero, which is just incredible. But more importantly, after you factor in all the operating expenses, taxes, and interest, they're still capturing a really solid 15.48% net profit margin at the bottom line. They are super efficient at turning their revenue into actual tangible profit. Furthermore, they are generating a massive 26.94% return on equity. You know, for any business, an ROE consistently above 15% is generally considered excellent. So hitting nearly 27%, that is just outstanding. It really proves the management team is highly efficient at taking the equity shareholders have entrusted them with and compounding it into some very significant profit. But it's not just about what they earn today, right? It's about how they're growing it. While revenue has grown steadily at over 9% annually, the free cash flow is the real standout here. It's boasting a compound annual growth rate, or CAGR, of an impressive 19.31% over just the last 3 years. This means the actual cash they have left over to reinvest in the business or pay out in dividends is growing incredibly fast. Section 4. The dividend track record. Let's see how they treat their shareholders. The dividend profile here is remarkably stable and super shareholder-friendly. I mean, they boast 16 straight years of dividend hikes. You get a healthy current yield of 2.24%, but for me, the best part is the safety. The dividend payout ratio sits at roughly 44%. That means they are using less than half of their earnings to cover the dividend, which leaves them plenty of room to keep growing it. And boy, are they growing it. We're talking a 15% compound annual growth rate over the last 3 years alone. Moving on to Section 5, historical valuation comparisons. These historical comparisons are, frankly, incredibly revealing. If we look across the price-to-earnings, price-to-book, and price-to-free cash flow ratios, we're seeing some massive discounts. The PE is sitting at 20.16, which is nearly a 20% discount to its 3-year average. And the price-to-free cash flow ratio, which many would argue is the most important metric of all, is at a whopping 28.89% discount compared to its 3-year norm. So, the data clearly shows us that relative to its own past performance, the stock is undeniably cheaper right now than it has been in years. Honestly, it's like the market is currently pricing Marsh & McLennan as if its absolute best days are completely behind it. It's demanding a much lower premium for its cash flows and earnings than it typically has over the last half decade. And finally, Section 6, our final financial verdict. We really have a true battle of narratives going on here. The bull case heavily relies on a very strong underlying business. We're talking massive free cash flow growth, that 24% margin of safety to intrinsic value, an elite 27% return on equity, and deep historical valuation discounts across the board. The bear case, however, well, it points right at that brutal recent price momentum, down 12.3% just this year. Oh, and it points to a somewhat elevated debt-to-equity ratio of 1.41. That sits above its historical 3-year average, and it could definitely be spooking investors in a shifting interest rate environment. So, with the business fundamentals showing such incredible resilience and high profitability, completely contrasting with that short-term price collapse, I'm going to leave it to you to decide. Based on all these numbers we just went through, are we looking at a classic value trap where the bad momentum is just going to continue to drive the stock down? Or is this a genuine, rare bargain just waiting to be seized by a patient investor? You'll have to weigh the margins against the momentum for yourself. Thanks for joining me on this explainer, and happy investing.